How to grow a small trading account. The most important rules when you're just starting out. What do you need to focus on that will help your trading account grow exponentially without big drawdowns? Let's, for example, say that you have a $1,000 trading account. You make an annual return of about 20%. And after 20 years, your end balance will be $38,337. Of course, you understand if you make better return, your ending balance will be higher. But what's really important for beginner traders, what you want to do is add to your trading account each month. So if we add $100 to our account every month, everything stays the same. Our ending balance will be $282,223. Pretty amazing. That's just from adding $100 each month. Of course, if you increase it, your ending balance will be bigger. It doesn't matter how small you start. The important thing is that you stay consistent and that you add an additional contribution each month. The more return you make, these numbers increase exponentially as well. So just getting 10% more return per year will give you an ending balance above $1 million. Pretty amazing. Now, there are more important things we need to consider when talking about how to grow a small trading account. It's definitely position size. I recommend when you're starting out just to follow the 1% risk per trade rule, risking 1% of your account value per trade. Because if we look at this chart here on why risk management is important, the percentage gain you have to make back to break even after a few losses increases exponentially when you lose more. Let's just look at if you have a 20% loss on your account. Well, you need a 25% return to break even. If you lose 50% of your account, you need 100% return of what's left on your account to break even. All the successful and best traders in the world understand this. Just look at what Paul Tudor Jones says. Don't focus on making money. Focus on protecting what you have. And Larry Hite says, frankly, I don't see markets. I see risk, rewards, and money. And Ed Seykota says, the elements of good trading are 1. Cutting losses. 2. Cutting losses. 3. Cutting losses. If you can follow these 3 rules, you may have a chance. Now let's look at what's the most important thing. Well, you really want to trade with a good risk-reward ratio. And what is a good risk-reward ratio? Well, if we look at if we traded this signal right here, you never want to use a risk-reward ratio below 1. You can see here the green area is smaller than the red area. It means that we lose more than we win. So we always want to win more than we lose. You risk $1, you make 2. And just to show you why this is important, with a risk-reward ratio of 1 risk and 2 reward, you can have a win rate of 33%, but you're still break even. If you have a risk reward of 5, you only need to win every 5 trade. So preferably you want both a high reward and a high win rate. And that's when you see some really good returns. Doesn't matter how small you start. The important thing is that you add to your account regularly, stay consistent, manage your risk, and don't lose money. Now, if you want to learn a simple strategy on really how to get a high win rate and a good risk reward ratio, check out this video.